Good evening, everyone. Thank you for being with us here. I would like to set the context with India is now in a very good stage where the startup ecosystem has now just not only focusing on growth at any cost, but they are morely focusing on sustainable value driven growth. So with this contest, I would start with a generic question to both of you. So in the current investing lens, when you all are investing in startups, what are the three main key value drivers which you look at it, apart from revenue obviously, or the top line and the bottom line EBITDA, but those key drivers which would suggest you as an investment opportunity into a startup?
Hello. First of all, thank you for having me. I think in any business that we look at, startup or otherwise, value growth or enhancement of value for us is usually revenue, expansion revenues, expansion margins, and expansion in multiples. So multiple that a business gets. So if you, in a good situation, you want to be on the right side of all three of these curves. You want to see increase in revenues, you want to see increase in margins, and you also want the market to give you higher multiple. Market or another investor to give you higher multiple for the business that you have built. And I think that stays constant. I think, but the factors which go into increasing the multiple associated with the business are probably lesser explained than revenue and margins, which are easier to comprehend. And a lot of that comes down to quality of management teams, how nimble a business is, because a startup needs to often pivot itself. It starts doing something and I won't say end, but ends up doing something else. And the third thing is that the kind of moats that you build around the business in terms of how resilient the business is, how diverse the revenue streams are, and so on and so forth. So I think revenue and margin are more understood, but the joker in the pack or the real kicker comes from if you can build a business which gets a much better multiple from the market.
Hi, first of all, thanks for having me here and really appreciate the opportunity. I think I completely resonate with what Ashish said. So I get an opportunity to work on both the sides. One as part of a VC fund and then as a part of a consulting outfit, the one that I run along with my colleagues. So, a couple of things that we, apart from what Ashish just mentioned, which are absolutely headline numbers and what's the product market fit, couple of things that we consider is the depth of knowledge of the people who are running. We essentially are a very early stage pre-seed kind of a fund where the predictability of the business will get discovered over a period of time. We look at scenarios if these are lookalike models or they are wrappers on top of any existing model. So the packaging might be different, but at the end of it, it's a model which already exists. We kind of try to avoid that. And the last two things is the agility of the team to tackle compliances. I think we are in a very evolving compliance space. We focus on BFSI, fintechs, AI, and deep tech. So all of us know, and more than me, all of you know that the compliance that you have to do in BFSI are far more stringent and they are ever evolving. And finally, the tech ecosystem that you've been able to build, which is it scalable enough for you to grow? I've seen enough number of startups where they started with a model and they had to spend significantly large amounts while they were growing and pivoting. So while I'm saying that, you do not expect the startups to know it all or a founder to know it all on day one. That is where people like us come into the picture and help guide them.
So Gaurav, just a follow-up question. One of the important point what Abhi touched upon was about the management team. Yeah. So many a time I feel like that the quality of the management team or the thought process of the management team, currently somewhere it is a kind of a value growth lever which is mispriced in India. What is your opinion on that?
No, absolutely. I think for us and personally me, I've come across largely two groups of such startups. One is, a young individual trying to build something, maybe in the early 20s, a technocrat, and they just go into it with the flow and, eventually might hit a barrier in terms of compliances or, the headwinds in compliances. So that is where they try to pivot. The second is an experienced first-time founder who, where the speed of execution takes a bit of a hit because you know all the compliances and you know all the headwinds that are about to hit you. So I think we try to find a fine balance for the ones who are first-time experienced founders. We try to enable them with speed of execution. So that is where the depth of the founding team and how the management is driving this team comes into the picture. For a young founder, of course, we act as a pillar where, I don't think it's any fundamentally different from a listed entity where you already have a board. So for a young founder, you might not expect that, but we come into the picture there where we kind of help them, handle them, and eventually help them grow.
Coming back to you, Abhishek, so lightly shifting towards the capital discipline. So generally in new startup, we have seen the concept of misallocation of capitals, mainly towards hiring, tech or expansion. So how as an investor do you intervene and guide those founders that their capital is not misallocated and you do a course correction without derailing their momentum also?
Well, we agree to a business plan, and the business plan obviously never gets adhered to because that's the nature of the business. I have never seen a business plan getting completely, adhered to, completely being sync what actually happens, and that is bound to happen because there are many assumptions that go into business plan. But I think that is one of the things that distinguishes a good founder from a not so good founder, like to the point that you're making. And fundamentally, when you are in a startup situation, you're trying to create a business which is differentiated. You're trying to create a business which is seen as disruptive, which is seen as something which has got a zing associated with it. And for that to happen, you have to allow entrepreneurs to invest in slightly non-conventional ways, compared to a large company vis-a-vis a small startup will sort of allocate capital in a different way. But it is certainly important that the efficiency of capital is maintained. So one of the things that we look at is revenue to amount of capital raised. And there are various metrics. Some people are happy with a 1x, some people want a higher multiple, So one way to look at it is to see whether the investments that you're making are actually leading to revenue generation or not. That is one part. Second is when you are looking at investments into tech, are really talking about building a tech product or a tech stack, or you're investing into people, or giving money to Google and Facebook, which is what ends up happening in the name of tech. More than 50% of the spends that we actually do is giving money to Google and Facebook for various kinds of marketing activities that you do. So I think the devil lies in the detail. I think the idea is to go to a level deeper, make sure that there's a broad adherence to the business plan, with the knowledge that there would be some deviations, and which is understood. But as long as there is commitment to revenue generation and there is commitment to building something differentiated, which is what the raison d'etre of the startup was, because when the startup starts, it is supposed to do something, right? So as long as you're moving in that direction, we are broadly okay.
So Gaurav, let's bring some investor playbook perspective here. So if I ask you on a point blank, what are the two most reliable drivers of valuation expansion? What would be those?
Had I known, I would have made much more money. Let me answer it that way. But yeah, do your customers love you enough? Are they coming back to your platform? Are you able to expand your services on either side? Eventually, I think one of the examples that I can give is there's a voice AI company that I've personally invested in. I think where they stand apart, and great to see the conversation about AI. That's what we keep telling our customers. You know, the ROI on AI is really important. It's not just a fancy implementation that you want to do and end up running out of money. So the voice AI startup that I'm talking about, they are not a wrapper around any of the LLMs. They've been able to build their core engines. Now they started as a inbound outbound enablement, but now they have expanded on both the sides in terms of integrating with the CRM to push certain and extract certain data, and on the other side able to create enough use cases for the ability to cross sell and upsell. So one of that is this thing, and of course we touched upon it, the depth of management. What is the kind of team that the entity has been able to assemble? Are they complementary skills? Are they adding enough value to each other? Because end of the day, you can't do everything on your own. You can't be a single lone founder and trying to build something. But that comes at some stage, and that is where we also come into the picture, trying to help them think through this. So I think if these two things, principally apart from everything else in terms of value and the product market fit, and how the compliance or the regulatory space is evolving, if we are able to sort these couple of things out, I think we are good in a good space.
So now as we wrap up this session, so I'll just give a industry point of view that in major of the startups where we work as an internal auditor on behalf of the investors or the AIFs, what we have noticed is those startups who have early adopted the governance practice, they have tried to achieve a value growth more faster. So based on that perspective, what do you think that when is the right time a startup should start investing in governance and internal controls, and they should be going all in for that? So I would request both of you to answer on the same.
I think the commitment to being more process oriented, if I may say so, should start from the very beginning. The level of the layers that you have might evolve. When you're a startup, you may not have a complicated board, you may not have a NRC committee, and so on and so forth. But what you should have is documentation. So the process should be documented. A lot of I would say SOPs, SOPs should be in place. I think it is ultimately a tool that the founder can employ to actually run his own business. So to me, it's less about whether you are able to create value by doing it. You should be able to if you're using the right way. But I think just in order to run your business in a manner in which you have a good handle on it, and you feel that you're in control of the business, having a serious amount of commitment to standardizing processes, having the right amount of governance structure is something that should come naturally to a good founder. And we have seen that time in, time out. I mean, we had a company called Flip Spaces, which scaled up. We saw it go from 30 crores to 330 crores and over a short period of time. And we had a good exit. We made a 9x on that. And one of the things that we really liked was that there were 4 entrepreneurs, there were 4 founders, but they, even when they were a small company, they ensured that everything, all the decisions they took was discussed, documented. Even when they didn't have a very high quality finance person, they still, made sure that their books were audited by reasonably decent auditors. They could not afford a big 5, big 6 at the point in time. So I think the commitment to building something which is based on fundamentally strong principles is something that is a cadence that one should have regardless of the level of evolution that one has.
I think I completely agree with that. And, just to add to that, for a new founder, you can't really expect them to have everything written on day 0. But I think, as Abhishek rightly said, if you have the fundamentals the basic SOP is in place, you're in a good space. And I think the last thing that you would want to do is you start getting a team in place and then everything is gone haywire. And you don't know the head and tail of the business and everybody comes in and tries to do their own stuff. And what you set out to do has completely fallen apart. I think as an investor or as a fund, the constant cognition and enabling the founders to have this in place on a very regular interval, maybe reviewing that because the space evolves really fast. So to say, AI startups every day, something new is happening there. So not just set it out once, but keep on reviewing it. And I think at the end of the day, it also gives the founders a lot of clarity on what is working and what needs to be corrected. Unless you kind of like all of us, unless you jot it down, you'll not remember anything. So that is from a very 30,000 feet. But yeah, I think once you are at a stage where you start entertaining customers, you should start setting these up in a very proper and structured way. I completely agree with that.
Absolutely valid points by both of you. We have personally implemented or documented SOPs for startups, and those startups have actually implemented those SOPs more in a better and a strong way than what a developed or what a well-grown organization would have adopted those SOPs. So thank you to both of our panelists, and thank you to everyone for being a great audience. Over to you, Disha and Deepika.